Hello and welcome back to Intelligent Investment Today. This is the podcast where we explore the principles of intelligent investing, not merely how to grow wealth, but how to avoid the kinds of mistakes that quietly destroy it over time. And today we're going to discuss another misunderstood concept in investing: risk. Now, risk is a word that investors hear constantly. Financial media talks about it endlessly. Advisors attempt to measure it. Institutions build entire systems around it. And yet, despite all of this attention, many investors still fundamentally misunderstand what risk actually is. Because true investment risk is often very different from what people perceive it to be. Many investors believe risk means volatility, short-term price declines, temporary uncertainty. But some of the greatest long-term dangers in investing come not from volatility itself, but from the misperception of risk. From feeling safe when danger is quietly bubbling under the surface. And these misunderstandings can lead to devastating long-term consequences for both individual and institutional investors alike. So today we're going to explore what risk really means, why investors so often misjudge it, and how false perceptions of safety can quietly create enormous financial setbacks over time. So without further ado, let's crack on. As always, sit back, strap in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. Let's begin with one of the most important distinctions in investing. Volatility is not necessarily the same thing as risk. Now, this idea sits at the very heart of traditional value investing. Because markets fluctuate constantly, prices rise and fall every day, and many investors instinctively associate those fluctuations with danger. But temporary price movement alone does not automatically represent permanent loss. A high-quality business whose share price declines temporarily may still retain its intrinsic value, and if a business continues generating strong cash flows and long-term earnings power, short-term volatility may ultimately matter very little to a patient investor. This is why investors like Benjamin Graham and Warren Buffett saw volatility very differently from modern financial theory. They did not define risk primarily through price fluctuations. They defined risk through the possibility of permanent capital loss. And that distinction is enormously important because some investments appear stable right up until the moment they collapse. One of the greatest misconceptions about risk is the assumption that familiarity equals safety. Investors often feel comfortable with what they recognise. Popular stocks, well-known institutions, widely accepted narratives. But widespread acceptance can sometimes conceal enormous underlying risk. History is full of examples where investors mistook popularity for safety. Technology bubbles, housing bubbles, banking crises. Periods where enormous amounts of capital flowed into assets that appeared secure simply because everyone else believed that they were secure too. And this is one reason speculative bubbles become so dangerous. As prices rise, perceived risk often falls. Investors become more confident precisely when actual risk may be increasing. Leverage expands, valuations stretch, standards deteriorate. But because prices continue to rise, investors feel reassured until, eventually, reality intervenes. This leads us to one of the most dangerous forms of risk, the risk investors do not recognise. Because obvious risks are often manageable. If investors understand a danger exists, they can prepare for it. But hidden fragility is far more dangerous, and financial markets are filled with hidden fragilities. Excessive debt, liquidity mismatches, over-concentration, speculative leverage. These risks may remain invisible during stable conditions, but periods of stress expose them very quickly. This is why value investors place such heavy emphasis on balance sheet strength and financial resilience, because strong businesses are generally better equipped to survive unexpected adversity, and survival matters more than anything else in investing. Another major misunderstanding involves the relationship between short-term comfort and long-term safety. Many investors pursue strategies that feel emotionally comfortable in the present moment, even if those strategies create long-term vulnerability. Holding excessive cash during inflationary periods is one example. Now, cash undoubtedly feels stable. Its nominal value does not fluctuate daily. But over long periods, inflation can quietly erode purchasing power. And this erosion often goes unnoticed because it lacks the emotional intensity of market volatility. Again, perceived safety and actual safety diverge. Likewise, investors sometimes avoid equities entirely, simply because short-term declines feel uncomfortable. But over long time horizons, avoiding productive assets altogether may itself become a significant risk, especially when inflation steadily reduces the real value of idle capital. Institutional investors are not immune to these misperceptions either. In fact, institutions often face their own unique forms of risk distortion. One major issue is career risk. Professional managers may avoid unconventional decisions, not because those decisions lack merit, but because being wrong conventionally feels safer than being wrong independently. This creates herding behaviour. Institutions crowd into similar assets, similar strategies, similar narratives. And while this may reduce short-term reputational risk for individual managers, it can increase systemic risk across the financial system as a whole. Again, the appearance of safety becomes deceptive, because when everyone owns the same assets, liquidity can disappear very quickly during periods of stress. Another dangerous misunderstanding of risk involves leverage. Leverage often creates the illusion of enhanced returns during good times. Borrowed money magnifies gains. Performance appears impressive. Confidence grows. But leverage also magnifies danger. And importantly, leverage changes the consequences of being wrong. A temporary decline that might otherwise be manageable can become catastrophic when excessive debt is involved. When markets become volatile, leveraged investors may be forced into decisions they would not otherwise make, selling assets at distressed prices, meeting margin calls, reducing positions under pressure. And this forced behaviour can turn temporary volatility into permanent capital loss. Now, another fascinating aspect of risk perception is how investors emotionally respond to recent experience. During bull markets, risk often feels low, because recent outcomes have been favourable. Investors begin extrapolating stability indefinitely into the future. Caution fades away, risk management weakens. But this is precisely when hidden vulnerabilities may be building beneath the surface. Conversely, after severe downturns, investors often become excessively fearful. Risk feels overwhelming, even when valuations may actually have become more attractive. This emotional asymmetry creates many of the market's inefficiencies, because investor perception of risk is heavily influenced by recent price behaviour rather than objective valuation or long-term fundamentals. The investor Howard Marks has often spoken about this idea, that risk is highest not necessarily when conditions appear frightening, but when investors have stopped worrying about risk altogether, because complacency encourages excess, aggressive lending, speculative behaviour, weak underwriting, and unrealistic assumptions. Again, cycles of optimism and pessimism shape risk perception constantly, and intelligent investors must learn to separate emotional sentiment from underlying reality. This is also why value investing places such heavy emphasis on margin of safety. The margin of safety concept, developed of course by Benjamin Graham, recognises something very important. Investors will inevitably make mistakes. Forecasts will sometimes be wrong, and unexpected events will occur. So rather than relying on perfect prediction, intelligent investors build protection into the purchase price itself. Buying assets below intrinsic value creates a buffer against uncertainty, and that buffer helps reduce the probability of permanent capital loss. Again, risk management is not about eliminating uncertainty entirely. That is simply not possible. It is about structuring decisions intelligently, despite uncertainty. Another major source of long-term investor damage is overconfidence. Success during favourable market conditions can create the illusion of skill. Investors begin believing they possess superior insight. They increase concentration, take greater risks, use leverage, or abandon valuation discipline. But markets have a way of humbling overconfidence eventually, and many severe investment losses originate not during periods of fear, but during periods of excessive confidence. Because confidence often reduces caution, and reduced caution increases risk. There is also a critical difference between temporary underperformance and genuine risk. Value investing itself often experiences difficult periods. There are times when speculative growth significantly outperforms disciplined valuation strategies, and during those periods, patient investors may appear out of step with prevailing market trends. But temporary underperformance is not necessarily permanent impairment, and this distinction matters enormously, because investors who constantly chase recent winners often end up buying assets after valuations have already become stretched. And this behaviour repeatedly contributes to poor long-term outcomes. Again, emotional reactions to perceived risk create real financial consequences. As we wind the discussion down, let us consider the broader lesson. Risk is not always where it appears to be, and safety is not always what feels comfortable. Some of the greatest long-term investment dangers emerge precisely when investors feel most secure. During speculative manias, periods of excessive leverage, or environments where optimism has replaced discipline. Meanwhile, temporary volatility and market pessimism may sometimes create opportunity rather than danger. This is why intelligent investing requires independent thinking, emotional discipline, and a willingness to question consensus perceptions of risk. Because ultimately, successful investing is not simply about pursuing returns. It is about surviving uncertainty without suffering permanent damage. And investors who misunderstand risk often pay a very heavy long-term price for that misunderstanding. And that brings us to the end of this edition. A look at risk, investor psychology, and the dangerous misperceptions that can lead both individuals and institutions into costly long-term setbacks. If it's been worthwhile, hit that subscribe button so you'll be alerted the second any new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.